For decades, the global economy has been playing the same wealth gamia strategy built on low interest rates, cheap credit, expanding debt, and ever-rising asset prices. From the Onenipethison through the early 2020s, this system fueled massive gains in stocks, bonds, and real estate. But in 2025, that 40-year wealth play just didn't. Most people don't even realize it yet. The next era won't be about easy money, passive investing, or simply buying the dip. It's going to be about survival, adaptation, and positioning for a completely different financial order. The playbook that made millionaires over the last generation no longer works, and the signs of this tectonic shift are everywhere. To understand what's coming, we have to rewind the story and see how we got here and why the entire structure is now cracking apart. Back in the early Onenipethison, after decades of high inflation, the U.S. Federal Reserve under Paul Volcker took interest rates to the sky to crush inflation. That move marked the beginning of a new economic era. Once inflation was under control, interest rates began a steady four-decade decline from over 15% in the early Onenipethison to nearly zero by 2020. This was the fuel for the everything bubble. Cheap borrowing costs meant governments, corporations, and consumers could pile on more debt. That debt, in turn, inflated asset values. Houses, stocks, and bonds all went up in value because money was cheap and abundant. Investors didn't have to work hard to get rich, they just had to own assets. The rich got richer not because they were smarter, but because the system rewarded those who already owned something. This was the great wealth engine of the last 40 years. Every financial advisor, central banker, and Wall Street analyst build their models around it. Buy the dip. The Fed has your back. Diversify in 6 statutory portfolios. It all worked because the tide of cheap credit was rising. Whenever the system wobbled like in 2000, 2008 or 2020, the Federal Reserve would step in, cut interest rates, and flood the economy with liquidity. The result? Each crisis was solved by creating even more debt and inflating the next bubble. The rich became asset billionaires, and the middle class was encouraged to take on cheap mortgages and chase stock market returns. It was a global feedback loop of credit expansion, and it created the illusion that wealth could grow forever. But illusions don't last. The death of the 40-year wealth play began quietly in 2021 when inflation came roaring back. For the first time in decades, prices of goods, services, and wages were rising faster than the economy could handle. Central banks had to do what they promised they'd never do again: raise interest rates aggressively. Suddenly, the easy money era was over. The Federal Reserve hiked rates at the fastest pace in history, and the consequences started to cascade. Bonds seen as safeguards in value. The 6 statutory portfolio model, the gold standard of retirement planning, suffered its worst losses in half a century. Housing affordability evaporated. Mortgage rates jumped from 3% to over 8%, freezing the real estate market. For the first time since the Onenipethison, the engine of wealth was running in reverse. What people don't realize is that this isn't just another cycle, it's the end of an era. The 40-year downtrend in interest rates that powered all asset growth is gone. Rates can't go back to zero without reigniting runaway inflation. Governments are drowning in debt, they can't cut rates forever without triggering a debt spiral. The global population is aging, productivity is stagnating, and geopolitical tensions are fracturing supply chains. The world that supported the buy and hold forever mentality no longer exists. The game has fundamentally changed, but most investors are still playing by the old rules. Look around, real estate markets are freezing up, corporate bankruptcies are quietly accelerating, and government deficits are ballooning beyond control. The U.S. now spends over $1 trillion a year just on interest payments. Neither doesn't build roads, fund innovation, or improve quality of life. It's a treadmill of debt servicing, and it's getting faster every year. The bond market is starting to revolt, demanding higher yields to lend to governments drowning in red ink. This is what the end of the wealth play looks like: an economy addicted to cheap money that can't survive without it, but can't have it anymore without blowing up inflation again. So what's next? If the old wealth game is dead, what replaces it? The answer isn't comforting, it's full of opportunity for those who can adapt. We're entering a new age of hard money, hard assets, and real productivity. The winners of the next decade won't be those who rely on central bank bailouts or stock buybacks. They'll be the ones who build, produce, and hold assets that can't be printed out of thin air. Commodities, energy, infrastructure, innovation-driven companies, and yes-elect cryptocurrency become the new lifelines of wealth. We're moving from an era of financial engineering to one of resource realism. In the 2010s, wealth came from speculation-wing tech stocks, flipping homes, or buying NFTs. In the 2020s and 2030s, wealth will come from ownership of real-world production capacity and essential resources. Energy independence, food security, manufacturing resilience, and decentralized digital systems will define the new economy. It's no longer about betting on endless growth, it's about surviving volatility and building systems that endure. Inflation isn't going away quietly, either. Demographics, deglobalization, and decarbonation are all inflationary forces. The cheap labor, cheap energy, and global trade that kept prices low for decades are fading. Supply chains are being reshored, wars and tariffs are disrupting trade, and energy transitions are raising costs. This means that the low inflation, low rates world that fueled financial bubbles is not coming back. Central banks are trapped; they can't cut rates to low without sparking inflation, and they can't raise them to high without bankrupting governments. The result? A permanently unstable system. Volatility is the new normal. For investors, that means one thing: the strategies that worked for your parents or grandparents won't work for you. Bonds are no longer a safe hedge. Passive index funds may not protect you when global markets devalue. Real estate, long considered a guaranteed winner, may stagnate as affordability collapses. Even cash, once seen as safe, loses value every year due to inflation. The only viable strategy now is flexibilizing, not in narratives, but in realities. Hard assets, real businesses, and adaptive technologies will be the new foundation of wealth. Take Bitcoin and gold, for example. For years, they were dismissed as hedges or speculations. But in a world where governments print trillions and debts spiral out of control, these assets represent something deeper: trust outside the system. They're not dependent on a central bank's promises. As the fiat system weakens under the weight of its own contradictions, people will increasingly seek alternative stores of value. We're seeing the slow but inevitable shift from financial assets, stocks, bonds, to tangible and decentralized assets, commodities, crypto, productive land, intellectual property. At the same time, technology and artificial intelligence are reshaping what productivity means. AI isn't just an innovation, it's an accelerant. It will create massive winners and losers. Countries and companies that harness AI for real productivity will thrive, those that use it just for speculation or hype will collapse. The next wealth cycle will be built not on credit expansion, but on value creation powered by new technologies and real assets. This will be the age of decentralized money, of energy, of data. The global system is fragmenting, and new centers of power are emerging in Asia, Latin America, and even digital economies that transcend borders. But make no mistake, transitions like this are not smooth. They're brutal. The collapse of the old wealth play means many people will lose everything they thought was safe. Pension funds relying on 7% returns from bonds and equities are in trouble. Governments depending on perpetual borrowing will face insolvency risks. The middle class, already squeezed by housing costs and inflation, will feel the pain of declining purchasing power. The psychological shift from everything goes up to nothing is guaranteed will be one of the hardest adjustments of this century. However, in every great economic reset, new fortunes are made. The question isn't whether the system is collapsing, whether you're positioned for the rebuild. The end of the 40-year play doesn't mean the end of wealth, it means the end of unearned wealth. The easy era of passive investing, low interest, and endless credit expansion has died. What comes next is an era that rewards knowledge, creativity, and courage. It's a world where you must understand macroeconomics, geopolitics, and technology to survive financially. For those who adapt, this is the greatest opportunity in decades. Energy innovative infusion, battery storage, and decentralized grids will create trillion-dollar industries. Blockchain technology will reshape finance beyond speculative coins, enabling transparent, borderless systems of trade. AI and automation will rebuild productivity, but only for those who use them to create real value, not financial bubbles. Real estate will evolve from speculation to utilities that generate real cash flow, not just paper gains. The next generation of wealth builders won't be be builders, innovators, and decentralizers. We are living through the death of the paper wealth era and the birth of the productive wealth era. The global economy is being rebalanced, and every crisis you see on the head-on, whether it's inflation, market crashes, or currency wars, is part of that process. The old model of print, borrow, spend, repeat is dying because math has finally caught up with the system. Debt can't grow faster than the economy forever. The Federal Reserve and other central banks are losing their magic touch because reality no longer bends to monetary illusions. The world is demanding real productivity again. So what's next? Prepare for volatility, but also for renewal. The 2020s will be remembered as the decade that broke the old financial system, but also the one that built something new. For ordinary people, this means rethinking everything you've been told about money. Save less in depreciating currencies. Invest more in things that produce, store, or secure value. Learn to navigate inflation rather than fear it. Understand how technology and geopolitics will shape supply and demand. And most importantly, stop waiting for the government or the Fed to save the market. You won't, because they can't. The 40-year wealth play gave the world a golden illusion of prosperity. It made millionaires out of speculators and turned debt into a source of growth. But that chapter has closed. The new chapter will be written by those who adapt to a world where capital must be earned, not inflated. The next decade will separate those who understand the system from those trapped inside it. This is not the end, it's the reset. The death of the 40-year wealth play is the birth of a new financial order. And the only question that matters now is, are you ready to play the new game?